Yeah. But all I'm trying to do is figure out, okay, how specific does this contract need to be? So right now, what they have written is shingles.
Okay, everyone, if we can get started for the property insurance panel, let's take our seats. We're moving right along, and apologies for the somewhat compressed schedule here this morning. We got a bit of a late start, and we're trying to get to lunch as quickly as possible, so we'll just be rolling right on through. We've got a program for lunch with Professor Stoddard, who unfortunately has to leave right at 12:55. So we're going to try to get in as much of that conversation as possible. And then we can have a nice little break in the second part of the lunch hour before the panel on financial innovation. So thank you all again for coming. Thank you to the panelists on property insurance. This is a very important panel. I like to explain to my students that at the United Nations and in the Intergovernmental Panel on Climate Change, they have the task of making sure that we are not underestimating the risks of climate change. But at the Office of Insurance Regulation of the state of Florida, they don't have quite the same incentive. They have to make sure that we are neither underestimating the risk of climate change nor overestimating the risks of climate change, because there are massive social losses and massive losses to the state and to property owners in the state, whichever way we err. And so for that reason, we have to get as close as possible to a really granular risk analysis that accurately reflects what the real risk is, and the front line in that effort to sort of put a real price tag on those kinds of risks is the front line. The first line of defense is the insurance market. The insurance market is, especially property insurance, flood insurance, hurricane insurance in the state of Florida, obviously has a short time horizon. And so to the extent that we're talking about longer term risks, the market may not be structured to take those into account. But the risk scenarios are changing and the projections are changing. We have had the flood insurance in the United States for many decades has been provided by the National Flood Insurance Program, which no matter who you think is providing you with flood insurance, behind it all is the National Flood Insurance Program. And that flood insurance program for a long time has been based on very old flood zone maps that, at least going back to Hurricane Harvey in the Houston area, were shown to be sorely outdated and in need of reform. Several attempts to bring market reforms to the National Flood Insurance Program were beaten back for political reasons, concentrated interests of people whose premiums would be affected. So it's been very difficult to find a politically feasible way of reforming the National Flood Insurance Program. And with the release over the past year and going into effect for existing structures in April of this year of Risk Rating 2.0, the National Flood Insurance Program has gotten rid of those old flood zone maps and is now going to have a more granular approach to, structure by structure, residence by residence setting of premiums depending on the particular characteristics of that residence. But moving ahead, moving forward, we will also be talking about the lessons that other kinds of insurance, such as the hurricane loss models and the wind insurance, have for properties that are on the front lines of climate change. So we're joined by a great panel today, a great panel of experts. First up will be Jeff Tchaikovsky, an FIU alum who serves as the director of the Center for Insurance Policy and Research at the National Association of Insurance Commissioners. Prior to joining CIPR, he served as the managing director of the Wharton Risk Management and Decision Processes Center at the University of Pennsylvania, and he's here from Kansas City, and thank you for coming down, Jeff. We have Shahid Hamid, is Professor of Finance and Chair of the Finance Department at the College of Business at Florida International University. He also serves as Director of the Laboratory for Insurance, Financial and Economic Research located at the International Hurricane Research Center at FIU, and he runs the hurricane loss models for the state of Florida. And then we have Palab Mazumdar, who's an associate professor in the Department of Earth and Environment with a joint appointment at the Department of Economics here at FIU. His current research focuses on understanding human dimensions of environmental changes and mitigations of natural hazards, and has published some great papers just in the last few months on some of the stuff we're going to be talking about here today. So with that, thank you all for joining. Thank you, panelists, for joining. And Jeff, please kick it off. Thank you.
Yep. Hi, hey everybody. Thanks for having me here. It's good to be here. And while they're pulling up my slides, one quick comment on what Mario had just said. While I certainly agree that the insurance industry is on the front lines of climate, there's one really important thing to keep in mind, is that the insurance industry is really on a short-term time horizon. Most of their contracts are 1 year in nature, right? So the risk that they're looking at is primarily over that view. So it doesn't mean that there aren't things that are ongoing that they can't look more longer term, but it's really important to keep in mind. I'm sorry, do I control the slides here, or are they?
Yeah, you've got a clicker. Do you have a clicker there?
Okay, thanks. So we were asked to talk about the future of property insurance, and I thought it would be good to sort of level set around the baseline of where we are today and how we kind of got here at a fairly high level. So I'm going to go through both homeowners, specific to Florida, flood. I'm going to talk a little bit about some aspects from a consumer's perspective, which you always want to keep in mind when thinking about insurance, and then get to the question of around addressing the future. I do have a disclaimer here. So I work for the NEIC. I don't know how many of you know who the NEIC is, but the NEIC, we are the support staff for all 50 states, the insurance commissioners and their staffs in those 50 states plus the 6 jurisdictions. So we are not regulators, so I'm not talking here as an insurance regulator. We support them in their jobs. I'm just curious, how many of you, since we're going to be focused on property insurance, how many of you know who the insurance regulator is in your home state here in Florida? Can anyone tell me other than Shahid and Mario? I'm sorry? Okay. So, yeah, the Office of Insurance Regulation, the current insurance commissioner is David Altmeyer, who actually is the past president of the NEIC. So the NEIC itself gets together. You will see regulatory aspects put out by the NEIC. It's where the 50 states and the 6 jurisdictions kind of converge on an issue and collectively say, here's what we feel about this from an insurance marketplace perspective. So anything I say today is just my personal opinion. It has nothing to do with Commissioner Altmeyer or any representation of the NEIC. So when we're thinking about property insurance, we already heard it today. It's expensive in Florida. These are some data from 2018. Hopefully you can see that, but on average in the state, it's about $2,000 per policy, just for your homeowner's policy, and that's the second highest behind Louisiana. Of course, when you're thinking about that $2,000 on average, there's probably going to be a pretty significant difference between homes along the coast and those that are more, inland. And again, just curious, is that in line with anyone's property rates here? Does this sound about right? Maybe low, high, okay. And that's just homeowners. And these rates have been, steadily increasing over time. And then even when you look at this on sort of a coverage basis, so the figure on the left is just how they've been increasing since the mid-90s. And you see that obvious increase there, and then cost per $1,000 of coverage. is roughly hovering around $450 per $1,000 of coverage in the state of Florida. So why do you think that is? Why are homeowners' property insurance rates in Florida the second highest in the nation? So insurance is based on risk. It's supposed to be risk-based pricing. And so the process here is, and we'll come to this in a second, there's probably some other factors that are involved with this, but the process is for your Office of Insurance Regulation, they receive rate filings from companies annually. And these filings are reviewed. And those rates are then approved by the OIR, and then they're set out into the marketplace. So that goes through a review process. And in terms of the OIR or any insurance department, this is really a fine balancing act, a fine line for them. Because as we just said, well, why are the rates what they are? They're supposed to reflect risk. So if risk is going up, then in theory, the rate should be going up. Why is that? Because for the insurance companies and for the marketplace to work the way it needs to, for the companies to be solvent, they have to charge rates that reflect risk, right? They're not a charity organization. They're a business. So they have to have rates that reflect the risk that they're underwriting and make a profit on top of that, right? And that's also, it's important for the market to be solvent. Right? You would hate to see your premiums be paid, and then when you go to make a claim, there's no money there. That does happen. We'll talk about that in a second. And there's a process in place to deal with that, but you need to have a solvent marketplace. But of course, then you already heard today, well, my rate went up 35%. So nobody likes to pay higher insurance rates. And so it's this balancing act, and these are typically, Commissioner Altmaier is appointed. He's appointed by the governor. And there are, in other states, there are commissioners who are elected. So there's a balancing act here between availability and affordability of insurance. And it was already said, these rates are supposed to reflect, risk, and you all know this. I mean, the risk in Florida for hurricane is greater here than anywhere else in the United States. These are just one-year return periods. This isn't the greatest graphic. It's the one that I could find based on something that I had been working on. And so you can just see here, there's really no other place in the U.S. That has the highest level of hurricane risk outside of, there's one red blip around the North Carolina Outer Banks. So when you're thinking about that risk, insurers that are underwriting, that risk have to account for that. They have to price for that. And so that risk is high, and so your rates will be high. But of course, insurers, they don't hold all of that risk. It's not feasible for them to do that because they don't have enough capital to do that. So what they do is that they take this risk and they offset it to other insurers. They offset that to the reinsurance market. And they also offset this to financial markets. So, and that is also, for them to do that, they have to pay for that. So what ends up happening is, even if there's risk in Florida, if it hasn't been moving, if there's sort of overall hurricane risk that's been changing nationally or even globally, because a lot of these reinsurers they write globally, they will account for that in their rates that they're charging on the reinsurance product. So property insurers in Florida have to pay for reinsurance to kind of offset this tail risk for their business model, and there's a fee for that. And as those reinsurance markets harden, those fees go up, and it costs them more to buy that reinsurance, again, for them to become stable. Shahid, I think, is going to talk a little bit about cat modeling, and which I think is going to be a critical component, I hope, of this program over time. So catastrophe modeling is the science of kind of understanding these catastrophic events and pricing them out. All the insurers use it. All the reinsurers use it. Dr. Shahid has developed a public loss model here that you should all be very proud of from an FIU perspective. That's used by the Office of Insurance Regulation in the state and companies. But it's a model. It's constantly evolving, and there's a lot of uncertainty in these models. So this can lead to some uncertainty around costs. Of course, you know, Florida has been growing dramatically, and these are also sort of high-end properties, a lot of them that have been coming into the space. So that drives up your cost of insurance. And hopefully most of you know, too, that you have a hurricane deductible or a wind deductible on your policy. That's going to be about maybe, I don't know, 5% of your cost of coverage. So you can think about that, 5% off of, you know, just a $100,000 home or 5% off of a $500,000 home. You need to have that amount ready to pay if you have a loss. So there's some uncertainty on whether or not homeowners actually have that. And so insurers need to kind of account for that, to think about, well, if these deductibles aren't met, how are we going to pay for that coverage? Then, you know, these things below here, you know, there's other perils that have been, you know, cropping up in Florida. I think you had some wildfires earlier this year. And of course, you've probably seen in the news, there's a significant wildfire threat in the western U.S. But you have, you know, other secondary perils outside of hurricane that you can think about, too, from an evolving climate perspective. There's been a lot of discussion recently around third-party involvement in claims activities. So that is certainly, you know, a part of the issue where these claims are, as they're being adjusted, they tend to have this tendency to go up. There's also a significant level of fraud in the property insurance industry. So insurers have to account for that as they're paying out claims that could be fraudulent, or that there's some, you know, additional costs that are being associated with this due to third-party involvement. And again, that's going to be embedded in the rates. And I'll come back to this later, but you know, this notion of mitigation in building codes is really critical, because all else being equal, if you have proper mitigation or building codes in place, your rates should be, you know, should be lower. So if that's not happening, it could, you know, lead it into the opposite direction. So there's a number of things that are associated with the cost of this, and this just gives you, this is, I think, is a really excellent article that describes the Florida marketplace. So you have, and these numbers, again, a little bit outdated, but 6.5 million policyholders buying their coverage from 157 insurers. And then these insurers, I'll talk about this in a second, are all types of, you know, private insurers. But then, of course, in Florida, you have a state-run insurance organization called Citizens. So you have policyholders that are buying from private insurers, you have it buying from Citizens, and then both the private insurers and Citizens are offsetting some of this risk to the reinsurance market. There's also this really interesting thing here called the Florida Hurricane Catastrophe Fund that provides separate reinsurance for the insurance companies. And then you can think of, again, off to the side here, whether it's reinsurance or some alternative financing like a catastrophe bond. You could be, or I'm sorry, insurance-linked securities, ILS. These are also other ways that you can go to the capital markets to buy reinsurance, essentially. So it's, and the thing off to the right, the Guarantee Association is there in case any of these companies fail. So if you think like, oh, I just go to State Farm and I get my policy, like, that's not what's happening, right? There's a lot of things going on here. And this is true for most coastal states. Okay, there's a lot of layering of this risk. And sorry if if hopefully you can all see these, and it looks to me a little bit small here, but this just sort of shows you the evolution of the direct premium that's being written and by type of insurer. So the blue bars at the bottom are these national carriers. Your State Farms, your Allstates, your the commercials that you see all the time. And you can see that that sort of level, even though you've had a significant increase in premium written, has not gone up that much. That's because a lot of these national carriers have said, wow, it's it's pretty risky to write in Florida. So we might want to put our capital somewhere else. So they've formed these sort of domestic-based components that are called denoted PUPs that have taken up some of that risk. Then you have the growth of Citizens in yellow, and then that gray bar, these sort of more regional-based carriers that have developed in Florida. So these are going to be smaller insurers that have less capital that they can access, and it's probably going to be a bit more costly for them to do so. So again, this is just to think about, like, what, you know, as the property market evolves, like, what do you want it to look like, right? Do you want bigger companies underwriting more of this risk? Well, what is it going to take for them to come back, right? Like, what do they need to be able to do that? If you think of Florida, again, relative to some other coastal states, these are loss ratios, or on average what, you know, losses are in relation to the premiums that they collect. And so these run about 84% in Florida, and it's the highest among any of the coastal states. So the important thing here is to remember, and this is on average, okay, but the important thing to remember here is that leaves them basically 16 cents on the dollar to pay for everything else. So insurance companies, they collect your premiums, they invest that money, right? So they get investment returns, but they're getting that 16 cents on the dollar to kind of remember that whole list of, you know, all those other things that I said are increasing costs. That's what they're, you know, what they're able to cover. And that's, again, why your rates are going up, so that they can, you know, think about that. The graphic off to the right is, again, just like, what does the state-based, you know, wind pool, what does it represent? Here in Florida, it's about 4%, which is, it's, you know, again, this is typical in some of the other states, so it's not that high, but they had gone through a pretty significant effort to reduce Citizens. It was running about 30% of the policies, but then that's when you had a lot of these domestic, these smaller insurers come in. So I'm going to switch gears here to talk about flood insurance. So everything I just said, that's only for your homeowner's policy, because as you all know, homeowners does not cover flood. So if you want to have flood insurance, that $2,000 that I showed you before, you have to pay more for your flood policy. So still, this is a high level of confusion for people, right? We did a survey recently nationwide, and again, these numbers we've seen this in the literature before. It's about 50% of people don't realize that their flood insurance is not covered under their homeowner's insurance policy. It's a problem because people think they're covered for flood and they're not. So, as Mario mentioned, most of flood policies are underwritten by the National Flood Insurance Program. You might buy your policy through what is known as a write-your-own carrier, but they don't hold any of that risk. The federal government holds that risk. They just sell it for them. So Florida is the largest shareholder by far of the NFIP. They're about 33% of the total NFIP marketplace, which is about 5 million policyholders nationwide. And they're also, what's been happening recently, I'll come back to this at the end, is that there's been a private market for flood that's been developing over the past 5 to 10 years. Florida is also the leader here, and it's about 27% of the 360 policies nationwide that are being sold from a private market perspective. And so what's happening now with flood insurance is it's moving from this sort of legacy-based system of rate making to what they're calling risk rating 2.0, or equity in action. And in a nutshell, and I'm happy to take questions later on this, but in a nutshell, the legacy methodology was really very general. So there were really two primary factors that were considered in your insurance rates before. What flood zone you lived in, which was a V zone, a coastal zone, or an A zone, which is at, you know, significant levels of flood risk, primarily fluvial-based flood risk from rivers, and then what your ground floor elevation or your first floor elevation was in relation to the base flood elevation. And those rates were set nationwide. So if you were in an A zone in Florida, you paid the same rates as an A zone in North Dakota. That might not sound so bad for you all, but for North Dakota, maybe that's a little bit different. So what they're doing now is they're moving to what would be more akin to how the private market would be writing this risk. And they're doing this on a more house-by-house basis. So, and they're running catastrophe models, and they're operating this more like an actual insurance company. And they're buying reinsurance, and they're going out there and running the portfolio in that way. But basically, they're going to have sort of individual risk, right? More granular risk that's going to be based on distance to the nearest water feature, and it's also based on a number of different perils: surge, fluvial, pluvial. I believe they even have groundwater, tsunami. There's 6 perils total. I can't remember what the last one is. And then they're going to take into account a lot more of your individual structural characteristics. So it's just a much more granular basis for pricing out your flood risk, which again would be really similar to how a private company would do this. And so this data is all publicly available, by the way. You can go out on that website that's linked there, and I'm happy to share these slides after. You can get by a zip code how risk rating 2.0 is going to impact policyholders in that zip. So in Florida, again, 1.7 million policies. You can see that for some of these policies, there's actually going to be a decrease in risk in your rates. So why is that? Well, because again, everything was very general. So this included those within the flood zone and those outside the flood zone. So what they used to do outside the flood zone is to say, we're going to charge everybody, and these numbers are fairly representative, $500 per year per policy. Because we don't have maps to reflect what this risk is, so we're just going to, it's $500. So now that's all changed. So there's going to be people who are going to actually pay a lot less. And then even within the flood zones, there's different gradations of risk. So before, you're in the A zone, it went from a 1-year return period to a 100-year return period. Well, the 100-year return period shouldn't be paying as much as the 1-year return period, right? They're at less risk. So that's also changed. So you have people that are going down. You have roughly about 70%. So we're talking about 90% of the policies are going to have a decrease or $0 to $10 per month on average increase. You know, the issue is on the far right-hand side of the spectrum here are the people that are getting an increase. And those increases can be relatively substantial. The other thing I just would like to point out here is 1.7 million policies, 5.9 million people without a policy. Okay, so I would, maybe 5.9 don't need a policy, but there's probably, even it's 50% of that, like, that don't have coverage, that probably need it based on some of the things we just saw from the last panel. My last few slides here, from a consumer's perspective, whether it's flood or even other natural disaster coverage, there's a lot of different things that drive how well people, whether or not they buy it. Again, so the 5.9 million policies that don't have flood coverage. So it's price, but it's also design of the coverage, different demographics, risk perceptions, how this is being messaged. And one thing I've been thinking about recently is just sort of the decision complexity. Again, I apologize if you can't see this so well, but what this is just, this is sort of a decision tree framework of how many different nodes you can go down to get wind coverage in Florida. So it depends on whether or not your carrier writes that. It depends on, you have to get some sort of separate policy, right? And it's the same thing for flood. Whether your community participates in the NFIP or it doesn't, you only get $250,000 worth of coverage. So homes, waterfront homes are probably a lot more on average than $250,000. So you have to go out and get excess coverage from the private market. There's all these sorts of different pathways that you have to go down. So when you think about this from a consumer's perspective, you kind of need to be an expert in pricing out insurance. And most people aren't. Most people don't want to be, right? So it's really important as you're thinking about how do you increase insurance coverage, for me is like, how do you think about easing the complexity of that decision making? And you don't have to know everything, but there has to be some better way to do this. So last thing here to think about, moving forward, it's a complex, multi-layered issue, right? Again, it's not just, hey, I'm going to go buy an insurance policy. I mean, maybe that's what you see, but there's a lot, going on behind that. I really feel that the catastrophe modeling and loss control, mitigation, and building codes play such a crucial role moving forward. We're so far off from where those things need to be in terms of uptake, and those really have a dramatic impact on your rates. And there was an example that was just announced here the other day: $462 million passed for home hardening in Florida. How are you going to attract private capital here for property, but also for flood? And again, kind of thinking about raising consumer awareness of these different risks and what their responsibility is around insurance coverage and having proper coverage in place, and trying to simplify that for folks, but also addressing issues of affordability, as Galen was just mentioning at the end there. There's a lot of low-income people that live in these areas, and they can't necessarily afford this. So how are you going to handle that? Thank you.
Hi.
Yeah, they'll pull it up in just a second.
Okay. So I'm going to talk about the CAT model. I'm going to talk about some of the reasons why the rates have gone up a lot. Jeff mentioned that the average premium was $2,000 in 2000, I guess, plus minus in 2018. Actually, it's $3,600 now. We've had dramatic increase recently. We're #1 in the country, and we've had something like 100% increase in premiums in Florida in the last 5 years, 30 to 40% last year alone. I was paying $3,000 10 years ago, 12 years ago. I was paying $6,000. I'm 20 miles inland. My coverage increased 25%. It's around $400,000, which is below the market value, but that's the assessed value. And now I'm paying $9,000. So, the $3,000 average or $2,000 average doesn't reflect the fact that in South Florida we're paying a hell lot more. Anyway, so let me start off by saying that Florida ranks #1 in total insured property value exposed to hurricane wind, #2 in coastal property exposed to storm surge. It's got $4 trillion in insured properties, of which about $2.18 trillion are residential, and all are exposed to hurricane risk. 79% is coastal, which is particularly vulnerable to hurricane risk. And of this, about $400 billion is particularly vulnerable to storm surge. We got a problem with the slide?
I'm sorry, there's a tech there. They have to restart the computer.
Okay.
So they'll pull your slides up.
Right. So let me just continue. About 35%, as Jeff mentioned, actually it's less now, of the flood policies, and 30% of the premiums originate in Florida. And we got 6.1 million homeowner policies. And when it comes, this is for the wind. When it comes to flood, 18% have flood insurance in Florida, to 35% in Miami-Dade County. So starting with Hurricane Andrew in 1992, we've had a kind of major crisis, okay, in personal residential property insurance market. And the crisis has become acute, gone down, and then comes up again. So there's great uncertainty about the nature of the risk and potential losses for the state and for the insurance companies and the reinsurance companies. Rates have increased dramatically, as I mentioned. For example, between 1990, 2012, there was a 683% increase. But more importantly, recently, in the last 5 years, we have had 100% increase, 30 to 40% last year alone. So what are the reasons for the increased risk? Of course, you have the increased risk of wind hazard, but you also have the increased cost of reinsurance, increased house value. That's on a total basis, not a rate basis. And you have a substantial cost of lawsuits, legal cost, associated with assignment of benefits and the wind plus flood cause of damage. When you have 95%, 90 to 95% coverage in wind, and you have only 18% coverage in flood, and you have basically a hurricane event, and you have a damage, a lot of the home insurance homeowners are going to basically say, well, it was the wind. It wasn't because if you have damage if water comes in through the roof or the windows and so on and creates damage, that's covered by the homeowner policy, okay? Flood is rising water. And so that has resulted in hundreds of thousands of lawsuits, which has created a problem. I mean, all these legal costs have been substantial. 2009, 8% of the property claims originate in Florida nationally. 76% of the lawsuits originate in Florida. The insurance industry paid $3 billion in 2019 for legal cost. It's huge. We have a lot of fraud. We have AOB problems with construction, with the adjusters and with the construction industry and so on. Anyway, so how do we make this affordable? Well, we have to improve the capability and accuracy of CAT models, improve the science. The models have improved dramatically in the last 20 years, but we still have some way to go. More testing, and most importantly, better data about the homes so that we can more accurately assess the risk. Reduce the legal cost and fraud. I think there's a special session going on. They've been trying to address this issue. Develop cheap, effective mitigation methods and technology. Shift the risk to the capital market through increased use of cat bonds and insurance-linked securities. The capital market, has gone up substantially. Is something like $100 trillion. $100 trillion for stocks, market capitalization worldwide, $120 trillion for bonds. Okay? Each day, market value of just the stocks alone go up and down multiple trillions dollars, more than $1 trillion a day. They can easily absorb, cat losses. Okay? That's the long-term solution, to shift the risk. Now, there's a pushback from the reinsurance industry because that's going to basically eat into their business. But the point is that, the cat bonds that exist right now are not really attractive enough. But at some point, they have to restructure the securitization to shift more of the risk towards the capital market. Okay, improve the building code. Building code is the best in the country, still not enough. You have the roof-to-wall connection is a big source of vulnerability. We have no business having wooden roof in this hurricane area. I mean, if you look at the buildings in Puerto Rico and Havana that had concrete roof and stone buildings, they did well. Okay? We really don't have any business with, they look architecturally beautiful. You have, these hip roofs and gable roofs and so on. They sell, okay? But the reality is ultimately we have to shift towards concrete roofs, period. We've got to strengthen the Florida Catastrophe Fund, which is basically the reinsurance program, cheaper reinsurance program for the companies in the state of Florida. And then we have to, at some point, restrict, as climate change issue becomes more acute, the height of the condo buildings. And I'll mention why. I'm going to touch upon some of these issues, not all. So let's talk about the CAT model. Starting in 2001, a multidisciplinary and multi-university team of professors developed the Florida Public Hurricane Loss Model. It's mostly based over here. About 40% of the work is done, but we have other participating institutions. This model has been used over 200,000 times by the state of Florida to evaluate homeowner rate insurance, conduct stress tests, We do annual stress tests on 60 to 70 companies for, for determining solvency and so on. So essentially, every year we get about exposure data on 6 million policies or so from the companies, and we process it through our model. We produce the output, and the state of, the OER determines what to do with it. But essentially, every rate filing goes through our model. And our model, and we have also, over time, provided a modeling service to about 30 companies, private companies, for fee. The wind model has gone through extremely rigorous review process and certified by the Florida Public Hurricane Loss model. It's very, very excruciating. They come in for 3 to 4 days, a couple of times a year, and every 2 years rather, and they basically cross-examine us, go through at the code level, because essentially the model is tens of thousands of lines of codes. These are some of the institutions that are participating. Okay, and now. Pre-Andrew econometric models were completely inadequate. For example, they predicted $80 million in 1992. For 1992, we had loss of $16 billion due to Andrew. Essentially, what the companies were doing is they're using the traditional actuarial method of looking at 10 to 20 years of past damages or losses, and basing their premium on that. And we hadn't had really any hurricane before 1992 for quite a period of time in Florida. So the premiums are ridiculously low, okay? The hurricane part was like $30 or $40 for a $75,000 coverage, okay? And what happens is we have a hurricane, suddenly the losses are extreme. So from an actuarial point of view, when you determine the pricing, it's gonna jump sky high. And then as time passes and there are no hurricanes, it comes down again, and then you have another hit, and boom. So you have wild swings. So what you need is really a CAT model, a physical, sort of a statistical, physical based off CAT model. So what's the model? It's a very complex state-of-the-art set of computer programs. The programs simulate and predict how, where, and where hurricane form, their wind speed, intensity, size, track, how they're affected by the terrain. So we got terrain roughness data on something like 29 million points of locations in Florida, and how they're affected by terrain along the track after landfall, how the winds interact with different types of structure, how much they can damage house, roof, windows, exteriors, interiors, contents, and so on, and how much it will cost to rebuild the dam, and how much will it be paid by the insurers. That's what the model is doing. Okay, it requires a multidisciplinary set of expertise. Engineering, metrology, hydrology, actuarial science, statistics, computer science, GIS. We've got a whole set of experts working on that. What can the model produce? Usually it produces what we call the average annual loss and the probable maximum loss. Okay? And these are typically, and we do it for building structure, content, additional living expense, and so on, and these are basically, or what we call the time element, and they're typically used by insurance companies as input in the rate-making process, and they're used by state regulators to help evaluate the rate filings. We can do scenario analysis, what if a particular type of hurricane lands, what sort of damage it will do, okay, down to this, street level, has the capability to estimate the loss reduction from different mitigation efforts. You get substantial discount for mitigation, okay, but there has to be some kind of science behind it. Insurance companies are not going to give discounts for mitigation. They literally have to be brought in kicking and screaming because, you have to provide some kind of basis for that in the models, just not our model, but other models too provide that. Models can conduct stress tests on insurance companies to assess solvency, et cetera. And more recently, the state has funded us to develop a flood model, which we have run into. It's much more complicated, the wind model, a lot more computational requirements, and especially the inland flood model, the pluvial and fluvial, due to rainfall and so on, is much more complicated than we thought. So it's taken us somewhat longer than we thought. We hope to have it ready next year. Okay. Pricing of flood insurance, as Jeff mentioned, has become contentious, both the state and the federal level. There was a movement, actually, in the industry, reinsurance industry and so on, were actually willing to insure privately more flood, but then Irma and Michael and so on took care of that, and Louisiana rainstorms. But in the long run, private sector has to be basically, has to get more, I mean, we have to attract private sector into the flood market. So we have basically, let's see, 15 or so components for the wind model, and we have added another 15 components for the flood model. And we've done a survey of the housing stock in the state of Florida. We figured out all the different combinations of features homes have, and each one of the more important, common ones, we have developed vulnerability functions, engineering damage functions. Okay, and we got 10,000 of them. So output from the metrology, 57,000 years. Actually, it's more right now. Of simulation generates stochastic set over 45,000 hurricanes, 20,000. Anyways, each simulated storm has an estimated track intensity of wind field at successive time intervals. The wind field model generates open terrain 1 minute to sustained, and these are corrected upward for terrain roughness, and then converted to 3-second peak gust wind, which really causes most of the damage. For each grid, an accounting is made of all the simulated hurricanes passing through, and essentially the wind estimates that we come up with are then become input into the vulnerability and the actuarial component. So some of the estimates, 60% of the probability of 0 hurricane, 1 hurricane per year, about 26%, 2 hurricanes, 9.4, 3 hurricanes, like in 2004, something like 2.8%. Now, wind versus speed versus height. Winds at 100 meter, around 28th floor or 30th floor, are 50% greater than wind at the floor for the same event, at the ground level, or 10 meters. If wind at surface are Cat 1, they're likely to be Cat 3 on the 10th floor. If winds are surface are Cat 3, they're likely to be Cat 5. So high-rise buildings are vulnerable to higher wind speed. Now, they have concrete roofs and everything, so that's good, but they're really vulnerable to water damage. Penetration from sideways and then percolation through the floors, down through the floors. And the condos losses can increase if there's a breach exponentially with height. So in the future, if there are more frequent and severe hurricanes, Florida may have to think about limiting the height of these buildings, because especially when you end up with more frequent 3, 4, 5 category hurricanes, the losses can really increase substantially. The engineering vulnerability component reduces vulnerabilities. I guess in the interest of time, let me skip on the details of the engineering component, but here's an example of what we produce. These are vulnerability functions. This is for the Central Florida windborne debris region, masonry building. So it tells you what the damage is at different wind speeds for weak, medium, and strong constructions. These are different mitigation features. If hip roof is better than gable roof. So on top you have an unmitigated structure, then you add mitigation features and the losses go down. Different wind speeds. For manufactured homes, the major change in regulation in 1994 had to be tied down. Mitigation features were required, and so on. Made a huge difference in the losses. Dropped down substantially. This is basically the damage frequency for different components of the house at different wind speeds. It's an example of what the model produces. Here is an example of a high-rise building. The one at the bottom looks good, but it had to be pulled down because of water damage. So water damage can be a big problem. The building codes, as I said, have improved dramatically, but not enough. We still have to do more. We have actuarial model components, algorithms. We need some minimum input data on the homes in order to run the model, okay? That minimum will get us some reasonable estimates, okay? But the reality is that if you want better estimates, you need more detailed data. You need data on, for example, year the house was retrofitted, the location in the condominium's location of the unit, are they on the 10th floor, 11th floor, 12th floor, the number of stories, sliders, area of the building, roof shape, what kind of sheathing it has, what kind of roof-to-wall connection it has, okay, and so on, decks, attachments, or garage door, whether they're reinforced. All these, if you have information on that data, the model can take these variables into account, but often we don't get the data. So we're working with, with kind of missing data. In that case, we have to basically make some assumptions based on the survey we have done on, on different counties for which this data is available. We come up with distribution of these different features and stick them in, but that's not, as accurate as you would get. So the insurance companies and others need to collect better data on homes for the CAT model to work. That's, I think, number one priority. Some of the estimates, for the flood model, we have come up with some preliminary estimates of the surges, maximum surges. Here's an example of what if Harvey type of hurricane were to hit South Florida and dump a lot of hurricane at the 20-inch, 30-inch, 40-inch, what sort of would be the inundation depth. This is an example of vulnerability function for the flood model. Estimates of what based on 2017 exposures, annual average loss predicted was 4.7 billion, 3 billion after deductibles, so there's a substantial portion that has to be borne by the homeowners. We've done what-if scenarios. These are the PML. What if the same hurricane were to landfall at different places in Florida? Turns out Tampa is really the most vulnerable. Hurricane coming in at 90 degrees in Tampa is going to go through Orlando most likely. Hurricane coming in, hitting Miami and going inland is going to go through the Everglades. So these are some of the estimates of what the losses would be at category 1, 2, 3, 4, 5. So you can see that in Jacksonville, 78% is the insurance company will pay only about 22% or something for one, but they will pay something like 86% for category 5. The rest is covered by deductibles and others. And for Miami-Dade, it's more like 55% for Cat 1 is that's paid by home insurance and by homeowners, I would say, and 16% paid by homeowners for category 5 and so on. So these are some of the, this is the, if we would have the same hurricane today with the exposure we have today, what the losses would be. For Andrew, actually, it won't be so bad because the houses that were built in Country Walk and other areas are much better, much more reinforced. So even though we have much more exposure, but because of the fact that the construction is so much better, the losses don't really go up that much. This is the mother of all hurricane, it's Cat 4, Cat 5, coming in from the bottom, going through Florida, Palm Beach, Miami-Dade, Broward County, and even affecting Orlando, $47 billion. These are some of the estimates of what the reduction in mitigation, reduction in losses you get from mitigation based on our estimates. Some of it has to do with the wind tunnel data, wall of wind, but mostly of our engineering modeling. So you can see that simple things like nails can make huge difference. And roof-to-wall connections, improving the roof-to-wall connection can reduce losses substantially. So put together, we can get as much as 40 to 41% reduction in losses if you have this mitigation. Why does it matter? So this is 2013. Now this is before the rate increases. Big one. $300,000 structure. If you have a 1992 built home, unmitigated, you paid, this is based on the actual survey of 20 insurance companies that I looked at. Median, okay? You're paying $13,500. If the same house is mitigated, you pay $6,500. Okay, substantial discount. If it's built 2005 building code, you pay $5,000. Okay, now I think flood insurance, I've already talked about it. Increased cost of reinsurance, for example, in 2020, NFIP brought $1.33 billion of reinsurance coverage, paid $205 million. Very expensive. Really not much, and in 2021, they bought 1.153, and they paid $195 billion. That translates to about 10.2% increase in premium between 20 and 21 alone. Okay, legal cost, as I mentioned, has substantial. There are legal issues. I'm going to just finish this quickly. I have some things on, well, some of the lessons we have learned, wood roof is not suitable, period. Got to move on to the, concrete roof. So engineers at FIU, they have developed, they've patented a 1.5-inch thick, lightweight, but strong concrete roof with waves, like a barrel tile that can bear more load. And they have done that, okay? And so this is a picture of the type of roof we're talking about, can withstand 200 miles per hour wind, but construction industry is not interested right now in adopting it. So we have some of the technology available that can reduce the risks substantially. Finally, transfer capital market risk. Okay, as I mentioned, we can transfer, there's a large unused capacity to transfer cat risk to the capital market through the cat bond and other insurance-related linked securities. The total property-related in ILS is about 20, outstanding right now is 20 billion, which is a drop in the bucket when it comes to the bond market, and 12.5 billion right now for cat bonds. Total since they started in 1997, 138 billions have been issued, and mostly they've been short-term. Okay, NFIP, for example, has $1.2 billion cat bonds outstanding right now. It's not much. So and then I have some slides on how you can do this, it's actually, the special purpose vehicle can be constructed, and how you collect premium and establish a collateral account and then sell securities to the market, some of the methods that are used to transfer this risk. But in my opinion, that can be improved substantially. Okay? That's it. Thank you.
Thank you, Shahid. So we have a hard stop at noon to break for lunch. So because we had someone drop out because of COVID, drop out of the last panel on AI and data analytics, I convinced Palab to appear twice today. So short presentation now on the insurance aspects, and then Palab will come back to give a longer presentation along with the big data analytics and AI panel at 4 p.m. Thank you very much.
Okay, let's see how this works. Okay, I think they're working on the slides. So, the presentation I'll, talk about primarily focusing on mitigation. So as you saw from Jap's and Shohit's presentation, insurance is going to be more and more expensive down the line. If you're trying to make the rate that reflects the risk. The question is also, and also Shohit showed how mitigation can keep the price lower, but still the challenge is people don't mitigate. And there's a lot of behavioral challenge and other things. So I'll try to focus on some very practical aspect that we tried in the state of Florida in the past. And basically, I will talk about a program called My Safe Florida Home Program. How many of you are familiar with that program? Anybody? No? Okay. So, but that's fine. So every time a major hurricane happens, like a Hurricane Andrew, Florida did, change their building code and, catastrophic fund and so on. Same thing in 2004 and 5, Florida saw almost 8 named hurricanes. It's like crazy. And after that, in 2006 and 2007, 8, 9, they came up with this program, My Safe Florida Home Program, basically encouraging homeowners for mitigation and, tying it up with the private market, insurance market, and, to see also some really cool institutional experimentation and so on. So I'll talk a lot about that, how information, incentives, and changing the rules or institution can be packaged in a way to make the insurance affordable and stable and so on. It's primarily based on wind insurance program, but the similar argument you can think of for flood insurance as well, and so on. So I'll try to be quick. So this is a My Safe Florida Home program in 2000. That CFO Alex Sink was the leader in putting this together. She came up with convincing Florida legislature to put $250 million, and later on with some additional hard funding, they came another $100 million to give free inspection, mitigation grant, and tying it up with the insurance pricing, convincing insurance to recognize those mitigation activities, and so their premium goes down. And if you qualify, your house has to be 300,000 at that time or less to be qualified. Your median income in that zip code has to be less than average. If you can qualify, you can get free inspection and also get up to $5,000 as a matching grant. If you can show that income hardship, they also waive the matching component and will give you directly $5,000. So here is a things that people, the inspector would go to your home and they would collect all this information on 6 different points: roof, gable ends, roof to wall, windows, doors, floors, all these different parameters, and they will basically had a software and will spit out a score which is 0 to 100. So based on that score, they also will give you a detailed report, things that you can do, recommended structural mitigation measures, and if you do those things, how your insurance rate will go down, how much and so on, what it will cost, and also up to $5,000 grant if you do all those things. So as you can see, we did some follow-up study on that, and still a lot of people are not aware of that program, but people are open to this, having a state financed inspector to come and collect those information, because information is critical. As Shohid mentioned, a lot of times we don't have the good data to make the home-specific rates and and so on. So so basically our study confirmed that it did convince homeowners to do mitigation, as it has been packaged in a good way and so on. So there's the people that applied for that program but did not get approved. This shows that we mapped those. We collected all this information from the state of Florida, that My Safe Florida Home program. These are people who denied because of different qualification. These are the people who received free inspection. That's almost like a $400 or $500, very detailed inspection, the value of that inspection and so on. And these are the people who received the mitigation grants, okay? So, our analysis confirmed that it was quite effective in connecting information, incentives, and with the private market, public, agencies and the homeowners. There's also risk management solution did a follow-up study and on that, and they also came up with some good indicators in terms of average annual loss reduction, probable maximum loss reduction with this program. And so they basically, the state of Florida spent like a $93 million, but the return from that grant in terms of loss reduction, almost $140 million. And it could be, they showed it can be much higher if you more targeted mitigation in high-risk areas, older structures, and so on. So in terms of investment on the mitigation, it's pretty high. And in this, federally, there is multiple studies that shows the return can be 4 to 6 times of the dollar you spend, but still we are having difficulty in convincing people to do those mitigation. This is another study from RMS. It shows that, specifically Palm Beach County, Dade, and so on. And you can see before and after how the annual average loss reduction, you can see the red spot is higher loss, and you can see the changes after and before mitigation, how that affects the loss reduction things. And in terms of the pricing, you can see almost 55% of the people who did inspection, they're eligible to average $217. You can say, well, you're talking about $3,000 or more pricing, and it's a probably drop in the bucket, but still it's over time you think about for $5,000 worth of mitigation, that's a good return. And so there is insurance savings, there is a reduced loss reduction benefits and all that stuff. So the question is that program did not survive. After year 2 or something, it did not get enough traction in the legislative, so it basically, lack of funding, it just disappeared. But there is still a lot, we did follow-up survey and all that, there's still a lot of interest and demand for this kind of activities. Similar idea can be transferred to the flood insurance and so on. So I'll talk about, a few things that can be, so the hurricane risk mitigation status for each home. When you are collecting those inspections, you are getting a huge wealth of data. Through this program, they almost got 10% of all the building stock in single-family building stock. So think about if we have 100% or 80, 90%, how good those data and how that can improve our rating plan and estimating the risk and so on. So if we want to make the insurance market affordable and stable, we need some complementary markets, basically, the markets for mitigation. So how do we do that? You have to develop credible signals to each structure, each home, and so on. And with this inspection report, if you do it well, if you do it in details and so on, you can produce that score. Basically, if that score, if you have the permission from homeowners to make it publicly available, think about all the other markets will come through: real estate market, mortgage market, construction market. These are all basically can use that information. So basically you are distributing the risk across different markets, so you will be more stable. That's one of the major aspects of risk management. You distribute the risk, you distribute the exposure. So Jeff and Shohid talk about insurance company looks into very temporally, very short horizon. One way to expand the right multi-year contract and so on. Another aspect is to distribute spatially, organizationally across different markets. That's also make those risks distributed and less exposure and so on. So basically, we need a more ecosystem-based approach where we are talking about put those risks into distributing your different buckets. So you are not just one insurance market has to deal with all these ups and downs and challenges and so on. So that's pretty much, and these are some of the work with my Safe Florida Home program that we did and so on. But that's pretty much I have to say. Thank you.
Thank you very much. So thank you very much. We'd love to have some time for questions, but unfortunately the lunch is outside. It's getting cold. This was a very detailed presentation on insurance stuff. What's going to happen now is let's file out those doors to get in line, and hopefully in the next 5, 7, 8 minutes we can be back sitting down with our lunches and roll right into the keynote conversation with Philip Stoddard. So we'll reconvene. We'll start that part of the program at 12:10. And sorry to keep rushing through, but at 1 p.m., when we're done talking, it'll be relaxed for 45 minutes until the third panel starts. Thank you all very much.